would you like to be able to discover how to do savvy investing with high returns and lower risk? Timothy Smith will tell us how to do it. And what's so special about Tim is he's a mission-driven wealth advisor, author, and the founder of Aurora Private Wealth. And with over 2 decades of experience helping high-earning creatives, influencers, and entrepreneurs grow, protect, and align their wealth with their purpose, he's also the host of the Financial Dad podcast. So, Tim, tell us, please, how can entrepreneurs and how can investors get a higher return on their investment with the lowest possible risk?
Welcome to Awakened Titans podcast with Lily Patrascu. Mind-blowing conversations with influential business titans sharing how you can manifest abundance, love, joy, success through quantum awakening, quantum manifestation, quantum healing, quantum miracles, exponential business growth, and innovative products and services.
Well, so it all starts with managing risk. So most of it is diversification. Everybody knows about diversification, pretty much. Then there comes what I call a structured overlay, you might call it. So there are a number of vehicles today that can reduce market risk, which is the remaining risk after you remove the business risk, credit risk, default risk with diversification. So if you have structured notes, for example, a lot of people are familiar now with structured notes. You might have a 20% downside buffer or a 30% downside buffer where you have a protection zone of sorts for against losses on the investments, and where you still have the upside to the investment. So all of these it's an entirely new world now of ETFs and structured notes and structured positions where you can reduce that market risk, and in certain situations you can even multiply the market return. So I bought today, for example, a high yield bond fund and 2 calls on the NASDAQ 100 that create one position that is lower risk for my clients because the high yield bond fund has less risk than the market, and the 2 calls create twice the return of the NASDAQ 100 up to a limit of about 40% total for a 2-year position. So, most people would be thrilled to have a low risk position that can give them 20% per year, right? So that's an example, just an example of it. But then it's an exploding area in the investment world.
Thank you. What would you like investors who typically invest in multiple different things? They invest, let's say, in startups, they invest in stocks and bonds and in property and like so many different areas of investment. What would you like them to know about this particular method that you are investing that they don't perhaps already know?
Sure. Well, first of all, it's just for the stock market part of it. So it's, they may have, as you said, private equity, hedge funds, a variety of vehicles that are more risky than stock market investing, typically speaking, but they may have a core of positions like in the S&P 500 or the NASDAQ 100, things like that. And this is for those positions to manage them with less risk without giving up the returns of the market or getting better returns than the market. So, that's the slice of the space that I play in terms of how I help people.
Thank you. What else would you like investors to know about your specific method of investing with high returns and lower risk?
Well, it's very similar to most other advisors in that there is an asset allocation and there are a variety of positions typically, just like any financial advisor might give them, or certified financial planner, of which I'm one. It's just that when it comes to parts of the portfolio, we're trying to reduce risk. Most of the money that I manage is all the money the clients have in the world. And they're mostly over 55, over 60 years of age. So they don't have another go around at accumulating their wealth, and so the risk management becomes a critical aspect of it, but they don't want to give up returns. to do that. So that's why I really specialize in this particular area, because it's a critical area for people who need market results but want to avoid market risks.
Thank you. Tell us more about why did you start investing with this specific method and not something else? Why did it become interesting for you to use this specific method for yourself and for your clients?
Well, first of all, because it's mathematically challenging and I like math challenges. So I just really, it's like a big math puzzle when you fit together various pieces into something that works and looks like it can accomplish the dual end goals of reducing risk and enhancing returns, or at least getting market returns for lower risk, things like that. So it's intellectually challenging. I enjoy that. It feeds into, I guess, my own stage of life. I'm 62. It feeds into the vast majority of the people that I work with, who, again, are my age or older. I've been doing this for 40 years in total. So, you tend to get some older clients as a result of that. And it just gives people comfort. It's great when you can say to somebody, listen, the way this is designed, you should not or will not experience the kinds of downsides in the market that, a 40%, 50% market hit that lasts for a year and a half or 2 years or 13 years, like the 2000 market crash that we had. You won't experience that because of the way that this is structured. So, it gives me confidence to work with the client. It gives them confidence to work with me. And it honestly, it just feels good. It's intellectually stimulating and it's fun.
Thank you. Tell us, how did you start Aurora Private Wealth, and what's the mission of your company?
Sure. The beginnings of Aurora Private Wealth go back to about 1997, when some friends of mine from another company wanted to join me. I had left that company and started my own investment advisory firm at that point, and after 10 years of being with another company. And I started a broker-dealer entity for them. So I had an RIA entity already, and I started the broker-dealer piece for my friends who wanted to join me. And it all just sort of exploded over time and expanded. We're just my vision of it was always just a boutique, high-touch, really well-managed organization for higher level financial advisors. We have about 100 advisors in 35 states around the country at this point, doing 8 figures of business. We are, we have very few problems with regulators or problems with clients' claims, things like that. We have a relatively low claim history and everything. So I just wanted to create something where a solid advisor who does an excellent job for their client would have a place to go and could really focus on doing what they do best, which is working for the client. And, it just has turned out pretty well for me, I guess you would say.
Thank you. Tell us about other investment strategies you've tried, and what was like your feedback on them versus this specific strategy?
Well, I actually started working with market risk strategies after the stock market crashed in 1987. Most of those strategies at the time were trading strategies, and I worked with a number of them for probably, honestly, 15 years, maybe, something along those lines. But there were always drawbacks to it. There was just no perfect trading strategy that always worked to help minimize people getting caught in a downturn in the market and could get them back into the market at an appropriate time, so that they didn't miss the ensuing uptick in the market that eventually came around again. So around 2018, maybe, structured notes started to come out. And that fascinated me, because these were fixed income instruments offered by the largest money center banks in the country. And they were offering to do what I wanted to do, which was to reduce market risk, ideally enhance returns, but generally speaking, there was more market risk reduction than there was enhancement of returns. As I got to know more about those instruments and how they work, the inner, if you unpack or, take up the hood and look under the hood and see how it works kind of thing. The notion of purchasing my own fixed income instruments and option instruments, derivatives instruments, came to mind, and that's how I ended up doing what I'm doing now, which is a combination typically of structured notes and what I call structured positions. So it's what underlies structured notes, but because there aren't intermediaries involved, the pricing is better and you get better terms. So that's kind of how I got there.
Thank you. Tell us more about Aurora Private Wealth. Tell us about what other functions does Aurora Private Health perform for its clients in terms of protecting wealth, and how and why is that so important?
Well, first of all, not every advisor with Aurora Private Wealth is as old as I am and is as focused on market risk reduction as I am. So some of them are, 45-year-olds who work with 45-year-olds and they're more growth oriented, for example. Some of them have unique business models where they just work with construction companies, as an example. So they're very different. Kind of all over the place, but what most of them do is some form of holistic financial planning, where they're looking at the big picture for the client, and they're helping the client to determine, their tax picture, their investment picture, their insurance picture, estates, wills, trusts, business continuation, college funding for kids, retirement planning. With an emphasis on investment management, which is similar to my business model. So it's a full look at the full situation of the client in most cases. Risk management in terms of insurance, like life insurance and disability insurance and health insurance and things like that, is generally a part of the services offered as well. I just happen to focus on the investment world more so than any other part of the financial planning process. We're all different, though.
Tell us more about the investors that this particular opportunity for investing is suitable for.
Sure. For what I do, they're typically investors who, again, are a little more conservative, who want market or better than market results, but don't want full market risk. They tend to be 55 and up. They tend to have somewhere in the neighborhood of $3 to $10 million of investable assets. That's pretty much the zone, if you will, that really works well for what I do. The stuff that I do tends to be multiples of market index driven. I know that makes no sense whatsoever, but $500,000 positions. Think of it that way. So if you want to get a multiple of those positions, you want ideally $4 million, $5 million, something like that, so you can get 8 or 10 minimum size positions that really will work best for the client. So that's generally the type of client that I'm working with.
Thank you. For those investors that, let's say, have between $1 and $3 million to invest, mm-hmm. Do you have an alternative in terms of investing proposition that could be a good fit for them?
Well, yeah. I mean, I can always work with structured notes and even structured positions on a smaller scale. It might be 30 to 50% of the portfolio rather than 100% of the portfolio. Which might be perfectly fine for some investors. So yes, I mean, you can do what I do with smaller dollar amounts. It's harder to customize it at smaller dollar amounts. That's the only issue that you run into.
Thank you. Is there anything else you would like investors to know about this particular investing opportunity?
Just that it's complicated, but it's fun once you come to understand it. And it's very powerful. It's really, I'm doing stuff today that I wish I had been doing for 40 years. If I could have been doing this my entire career, I would have had a much more stellar career than I've had, even with all my success. And I really look forward to educating my clients on how this works, because it's really quite interesting when you like I said, when you unpack it. or pull back the hood and look at what's underneath these types of investment instruments. These are things that Goldman Sachs has been doing for people for a long time. I'm just bringing it down and democratizing it and making it available to people at smaller asset levels. That's all.
Thank you. I assume that for investors of $3 to $10 million, they would need to connect with you in order to for you to kind of establish a particular strategy, and then I assume you would run it for them. They wouldn't need to do anything, right?
Yeah, that's correct. I am a money manager. I don't I don't have a book where I give away the information and you can just pay for the book kind of thing. I enjoy creating these positions, trading these positions. I enjoy doing the work itself.
Thank you. Tell us more about what's the secret for your success, and what would you say helped you bring Aurora Private Wealth to the caliber that it is today?
Well, first of all, I have a terrific business partner in the company, a family out of Orlando, Florida, that owns a large company in the United States. This is a private equity investment for them. And I've been dealing with private equity investments, family office investments for 25 years now. So they're wonderful to work with, and they offer tremendous advice and business savvy and all of that. I would say, as to my own part of it, finding great people and then letting them do their jobs is a critical element to success, because you can't do it all on your own, and you can't micromanage good people. If you want good people, you got to let them do their jobs, and if they're good at it, they don't need you standing over them, watching them, basically. And I think, as to my own characteristics, I have a lot of perseverance. I'm pretty tough at the core, and I stick out problems and downturns, and I handle adversity well. So I think, there are good times and bad times in business. Life is just a big roller coaster in some respects, right? We go from great times to the death of someone we love, to more great times, to business problems. We just sort of rise and fall in life over time. I've been very good at keeping a steady hand when things are going bad, when markets are going bad. I have the right demeanor for handling chaotic situations, I guess you might say. And, that has served me and my clients very well over time, just knowing how to stay calm in a storm. I think I got that because I was an actor as a young man, and a few times on stage, we had to ad lib and make something up because somebody didn't come on stage, or somebody didn't say their line, or somebody didn't do something. So you learn how to remain calm even when you're in inner turmoil, from those types of life experiences. And I think that has benefited me greatly, as well as my clients and my staff, and our advisor force with Aurora, because I don't go crazy when things go crazy. I just remain calm, and eventually it all works its way out.
Thank you. Tell us about your 10 commandments for the psychology of successful investors. Like, what would you say a successful investor needs to do, to put in place, in order to invest successfully over the long term? What would you say are the 10 things they would need to consider to do?
Well, I hope I can come up with 10, but I'll give you what I think matters. Let's start with what I just mentioned, which is the ability to remove emotion from decision making. Okay, so when it's your money and it's going down, it's really hard to be objective and to look at it and say, okay, I am appropriately positioned. These are all good companies, or good mutual funds, or good ETFs, or good stocks, whatever they are. This is a passing issue. The wheels are not coming off the bus. This is a correction. This is whatever, and just stay calm through that storm. Number one. Number two, you really need to do research and learn, what risk is in the markets, how to de-risk your portfolio. I often see people with 4 or 5 holdings. One of them is 80% of their holdings, so they have concentration risk, for example. And they think because they bought 5 good things that they have a good portfolio. And folks like me, financial planners like me, would want them to have a more diversified set of holdings and not so much concentration in any one holding, of course. So do your research to learn about what typically works well long-term for investing. That may mean how to pick a stock, how to sell a stock. That's another thing you need to learn is how to sell. A sell discipline is really important to good investing, because many times if you just ride something up, you may ride it right back down if it goes down again, if you're not doing something to sell at the right time. So I think those things would be important. I think having the right time to give to it. I happen to just be a crazy guy for current events. I love to read what's going on in the world and to follow politics and government and finance and things like that. So I think having an interest in those things is really important, because these all give you keys to what's going to happen. So will rates go up, or will they go down, or will they stay the same? Interest rates. Well, here's another thing. When things do what you think they're supposed to do, then you should be ready to act the opposite direction. So, for example, if you think rates are going to rise and you've put money into money markets waiting to buy government bonds when rates have risen, now that they've risen, and there's probably more pressure to the downside on rates than to the upside on rates, well, it's probably time to buy. But a lot of people wait until they think it's perfectly peaked before they try to buy in. So, don't wait too long to take steps that need to be taken, I would say. I think those are kind of some of the keys to it all. Just be patient. It doesn't happen overnight. It doesn't, meteoric stock market gains are nice, but they're not constant. And sometimes you get it and sometimes you don't. But it's a long game. It's a lifelong pursuit. It's a lifelong thing to invest money for people. I'm investing for the rest of their lives. You should be investing for the rest of your life, between now and retirement, and then retirement, until you pass away. So it's a long game. And trying to get there too quickly, people can make mistakes like over-concentrating in a given stock, or, 80% in crypto would be speculative to me, just as an example. You know what I mean? So broadening the base, and thinking long-term. I really think that's what's important. Well, somebody said to me once, and this is a great one, watch the tide, not the waves. So if you're at the beach, you see the waves keep coming in, going out, coming in. Watch how far up on the beach they're getting. Are they getting farther up on the beach or not? Are they getting farther away on the beach or not? That's the tide, not the waves. And the market is like that. People who watch it every day drive themselves crazy. Watch for trends, 3 to 6 month trends that are happening in the market, not day-to-day trends that are happening in the market. So you can really drive yourself nuts by watching the market every single day and, trying to make a decision every day about what to do about the market. For the most part, just being long in the market, just being in the market and being patient in the market is what works, as crazy as that sounds. Whether it's an index fund or a good portfolio of stocks, it all can work long term. You just got to be patient.
Thank you. Tell us where entrepreneurs can connect with you.
Great. Okay. Well, first, my email address is Tim, T-I-M, at Aurora, A-U-R-O-R-A, P-W, as in private wealth, AuroraPW.com. Our website is AuroraPW.com. And I'm putting up a new site called StructuredPortfolios.com. It's not up just yet, but it will be up probably within a week or two. So if they want to check back, they could find me there too. And I'll be tim@structuredportfolios.com will be my email address for that part of my business.
Follow us for more interviews with world's most influential business titans, providing you with the insights to awaken to your full potential so you can get paid to be yourself, find true happiness, and manifest anything you desire.